All right, welcome to This Explainer. Today, we're diving into a genuinely fascinating situation with an under-the-radar industrial services company called Team Inc. You'll see them trading under the ticker TISI. Right now, this company is presenting one of the most conflicting financial narratives in the entire market. I mean, it's a story where incredible operational momentum is just colliding head-on with a downright terrifying balance sheet. So we're going to unpack exactly what's going on behind the scenes here. To set the stage, here's the central mystery we want to figure out today. Why on earth is a CEO aggressively buying up his own company's stock when Wall Street analysts are explicitly telling investors to sell? It's a massive, fascinating conflict between external warnings and internal confidence. And to figure out who might actually be right, we really need to look at the underlying numbers driving this crazy divide. Okay, let's dive right into this. Section 1, the Team Inc. turnaround. Before we can really grasp this financial paradox, we need to know what this company actually does, right? Team Inc. provides critical, highly specialized inspection, maintenance, and heat treating services. We're talking about the gritty, essential maintenance for energy pipelines, massive chemical refineries, and increasingly the construction of new AI data centers. It's the essential infrastructure work that keeps things running. And lately, business has been exceptionally good. In the first quarter of 2026, their revenue hit a highly impressive $215.1 million. That's an 8.3% increase year over year. But here's why that actually matters. This isn't just some slight beat. This marks Team Inc.'s absolute best first quarter performance since all the way back in 2019. So the top line growth, it is absolutely there. And as you can see here, this brilliantly illustrates their operational momentum. Their Q1 adjusted EBITDA, which is basically their core operating profit, saw a massive 45% jump, reaching $7.7 million. And, this wasn't just a fluke in one random division either. Management reported strong, tangible growth across both of their core segments, inspection and mechanical services. They are getting significantly more profitable on the revenue they're bringing in. Looking ahead to the rest of the year, management laid out their full-year guidance. They're targeting revenue between $920 and $945 million, alongside an expected EBITDA of $68 to $73 million. If you take the midpoint of those projections, it implies roughly a 16% growth in EBITDA. So, from a purely operational standpoint, things are moving swiftly and decisively in the right direction. Honest to goodness, if this were the whole story, it would be a clear-cut win. But, as you might have guessed, it is definitely not the whole story. Section 2, the $357 million anchor. Now we have to talk about the major caveat that is violently pulling against all those strong operational numbers we just looked at. First, we've got to look at the size of the company in the eyes of the public market. The market capitalization for Team Inc. is sitting at just $76 million. In the world of publicly traded industrial companies, that is incredibly small. And it sets up this dramatic irony when we look at the other side of their ledger. Because here comes the narrative whiplash. Contrast that tiny $76 million market cap with this staggering figure, $357 million in total debt. When you combine that massive debt load with the tiny market cap, it pushes the company's enterprise value, which is their market cap plus debt, to over $420 million. The debt completely, entirely overshadows the actual equity of the business. So, the absolutely crucial point is captured right here in this eye-watering metric, a debt-to-equity ratio of 2,318%. Yes, you heard that correctly, 2,318%. What this astronomical percentage essentially means is that the market is assigning almost zero value to the company's actual equity. The debt holders effectively own the enterprise, and the stock price is really just reflecting a tiny sliver of hope. When you're carrying that kind of leverage, there is absolutely zero margin for error. Any operational misstep, any sudden interest rate shock, or a project delay could put fatal pressure on the balance sheet. And even the company's own management acknowledges these intense pressures. They've explicitly cited risks like ongoing Middle East conflicts that could potentially delay some of their short-term turnaround work. So the sword of Damocles is definitely hanging right over their operations. Which brings us to Section 3, Wall Street versus the CEO. With that frightening balance sheet established, let's explore this fascinating tug-of-war happening between the external analysts evaluating the company and the internal leadership actually running the show. This situation perfectly encapsulates the whole debate. On one side, Weiss Ratings, who happen to be the only analyst actively covering TISI right now, has slapped a firm sell rating on the stock, pointing directly at that crushing debt load and the massive execution risk. But on the flip side, in June of 2026, CEO Gary L. Hill stepped up and purchased $100,000 worth of shares with his own money. So, who's right here? The loan covering analyst warning of a cliff, or the CEO backing his own turnaround plan with hard cash? Now, what's really interesting here is the psychological weight of that insider purchase. Relative to the company's tiny $76 million market cap, a $100,000 buy is a massive, highly visible vote of confidence. The old market adage really applies here. Insiders might sell for a dozen different reasons, but they only buy for one. They think the price is going up. They certainly don't typically buy if they see an immediate, unavoidable balance sheet crisis right on the horizon. All right, pivoting to the future. Section 4, Future Catalysts and Risks. To figure out how this tension resolves, we have to look ahead and outline exactly what is at stake as we approach the company's highly anticipated next reporting date. The date everybody has circled on their calendar is August 12th, when Q2 earnings drop. Now, analysts are currently projecting a steep loss of $5.94 per share on estimated revenues of $208.9 million. But honestly, the market already knows about the debt. They're going to focus way less on that bottom line net loss and significantly more on the operational metrics. Specifically, they want to see EBITDA margin expansion and, most critically, the generation of free cash flow, the actual cash left over after operations to service all that debt. This extreme high-wire act going into the earnings report really boils down to this table. The bulls are eagerly watching for high-margin liquefied natural gas and power plant contracts, maybe some expansion into that highly lucrative new AI data center construction vertical we mentioned earlier, and ideally a debt refinancing or equity raise to fix the balance sheet. But the bears? They're watching for the terrifying risks, skyrocketing interest expenses just entirely eating up those hard-earned profits, Middle East project delays actually becoming a reality, or worst of all, a highly dilutive stock offering to raise emergency liquidity at the expense of current shareholders. Let's bring all these pieces together. Section 5, High Risk, High Reward. This is where we summarize the classic turnaround setup we've been exploring in this explainer today. While the CEO's confident insider buy is genuinely a great sign for high-risk investors, we have to remember the absolute golden rule of corporate finance right here. Equity holders are last in line if things go wrong. If you're an aggressive investor who can stomach extreme volatility and use strict position sizing, well, this is a really fascinating turnaround story to track. However, if you're managing a conservative portfolio, that Weiss sell rating is a sobering reminder that this stock should probably be a strict pass for you. The structural risks are just too high. Which leaves us with one final provocative question for you to ponder today. Do you have the stomach for this kind of extreme volatility ahead of that August 12th print? It is the ultimate battle between operational momentum and balance sheet gravity. So review your own risk appetite, keep a close eye on those cash flow numbers, and as always, stay sharp out there. Thanks so much for joining me for this explainer.